Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I am Manisha Gupta. Let's begin with the wrap of all the action from the week gone by, and it was the industrial metals which gained on the back of a fall in the US dollar as concerns over the inflation trend drove investors to move the money into hard assets. It was an impressive week for zinc, nickel and copper, with zinc hitting its highest level in 2007, nickel at its highest in 3 years as well. The copper prices are headed for the biggest weekly gain since the month of November. Aluminum, though, didn't have a very great week, with prices sliding as stocks of the metal saw the biggest weekly gain since May of 2009. In the other metals week to date, zinc prices are trading up 5.5%, lead is up 2%, while gold and silver prices as well gain nearly 3% for the week. Let's talk more about the gold prices then, and they are trading to the nearest in the highest level since August 2016, up 3%, and in a month low that we saw it touch in the previous week. Another precious metal in focus is palladium, which is also set to see its best week since the month of October last year. On the crude oil front, prices are trading at a one-week highs on the back of weak US dollar. The dollar index itself is down 3% in 2018 till time. Although OPEC has said it is committed to cutting supplies, US output has been on the rise and hence the prices have been under some pressure. Remember, the crude oil prices have gained 50% in the second half of last year, and in 2018 now, of course, we have seen some pressure come in. Joining us to talk more about the outlook of crude, gold and metals is Edward Morse. He's Global Head of Commodities Research at Citigroup. Ed, hi, it's a pleasure to have you on the show. What is your sense on the crude oil prices? We did see $70 per barrel, but the prices did not sustain there. What is your sense on where are we looking at, and where do you see the prices headed from here?
Yeah, so we have been of the position that the move of Brent above $70 was always going to be temporary. It was not really sustained by fundamentals. It was a function partly of tightening fundamentals in the Northern Hemisphere's winter, given the exceptionally cold weather in both China and in North America, which had boosted up demand for all forms of fuel, whether it's coal or natural gas or oil, particularly on the diesel heating oil side. But what we saw in the months of December and January, the latter part of December and the beginning of January, was a kind of euphoria in the capital markets, with a lot of inflows coming into all asset classes, but particularly into commodities. And the reasons for it were two or threefold. First of all, there was a sharp decline in the US dollar, and a lot of traders had the view that the sharp decline in the US dollar meant that commodities would be on the rise. We know from recent history that that is really a temporary factor in the market, and we estimate that not more than 20% of the move up was a function of the US dollar's decline.
All right, Ed, that's an interesting take, of course, on the dollar movement and its impact on the crude oil prices. So what would you say? Have we seen the 2018 highs for crude, or is there a chance of a spike in the prices by, let's say, third quarter as we go ahead?
Yes, well, I'd say that while I give a good 60% probability to this lower case that we are proposing, we think there is a good possibility that there will be something that will lead to a price spike over the course of the year. So if we look at 5 particular members of OPEC, starting with Venezuela, but then looking in Africa at Libya and Nigeria, and then looking into the Middle East at Iran and Iraq, these 5 fragile countries, the fragile 5 members of OPEC, could all of them see a supply disruption over the course of the year? When it comes to Venezuela, we're already seeing production falling. Year on year, that fall on a rolling 12-month average is about 400,000 barrels a day. That is likely to keep up. It may even accelerate. And we think that Libya and Nigeria, having returned from lower levels of production to a higher level, we think this higher level may not be sustainable. So the chance of a disruption in Nigeria and Libya, together with Venezuela at the same time, is very, very high.
All right. That's about the crude oil prices and lots of fundamentals to watch out for. But Ed, this is a week where we've seen 3% gains come in for gold prices. Also, last week, same time, we were trading around 1,300. We are trading around 1,360 right now. Where do you see the prices headed?
Well, we see the gold price actually more likely to go up a bit rather than go down. And the reasons for that is that gold is a particularly strong hedge against wild cards in the commodity markets, particularly in the oil market. And as we look around the planet, there's plenty of political risk, whether it's focused on the People's Republic of Korea or areas in the South China Sea or the Middle East, and including where we looked just a few minutes ago at oil in Nigeria and in Libya. We also note that gold responds to rate increases, and that's because there are inflationary expectations in the world. I think everybody looks at what the Federal Reserve Bank, among central banks, is doing, and gold has become very sensitive to that barometer. So we would not be surprised to see gold inching up higher over the course of the year in response to those activities, and flows into gold should continue strongly as a result of the wild card opportunity that would come should there be some kind of political issue arising in the world. Silver is a relatively different issue. It responds more than gold does to the jewelry market. We think that there may be some room for an upward price correction in silver, getting it back in the upper teens in terms of U.S. dollars, maybe even hitting 20 at times. So, that's it for those two particularly precious metals.
So even as you are bullish for both the metals, the precious metals, that is, what is your sense on the range part of it? Would you say that we perhaps have done the bottom for gold prices right now? And if yes, how much higher are we looking at the prices from here on?
So we think gold is going to be in a 13 to 1450 range, going up and coming off, but maybe ratcheting up a bit to a higher price level. And we think of silver in a $17 to $19 range. Again, we're at the lower end of that at the moment, and we think it could inch up over the course of the year.
Ed, done crude and gold prices, but the best performance of this week clearly comes in from the industrial metals, where we have seen them headed for one of the best weekly gains in months and years, actually, with most of these metals trading at a multi-year highs. Where do you see these prices moving in? Do you see more strength coming in? And would you have a favorite when it comes to the metals as a sector?
We are looking at the metals category as an area for enhanced investment and investment opportunities, both on the equity side and on the underlying commodity side. China lies significantly at the heart of this, of course, and even with the changes in the prospects for Chinese GDP growth, the metals demand in China is likely to stretch the limits of production capacity, both within China and globally. And within China, we note there has been this strong policy unfolding under Xi to shut in production that is expensive, that is super abundant. We've had production of aluminum shut in, of copper shut in, and that means a bigger pull on the global market. Our favorite metals for the year are nickel and zinc. Zinc, because the supply-demand balance is reaching a point on the cost curve where there has been limited investment where we can see new investment on the horizon. So we think we need a bit more of a boost on zinc to get that incremental supply into the market.
Sure. But, you know, Ed, even as you say that nickel and zinc are your favorites, while zinc has doubled in last 24 months, how would you look at the nickel prices going forward, though? And what also is your sense on copper, other minor metals, etc.? I mean, barring, of course, aluminum, because that, I assume, would be an exception as supplies are on a rise on that one.
On nickel, what we're seeing again is supply-demand balance is going up, particularly in the case of nickel, like cobalt and lithium. It is very sensitive to electric batteries. China is in the lead on building electric vehicles, on electric battery technology, and this should boost all of those metals that are particularly at the core of the EV phenomenon that's unfolding. Finally, copper, we see demand growing in China, partly through the vehicle side, partly through the construction and building side. Less so this year than we had previously thought would be the case on building out the grid or building out power plants. So we see power construction and grid construction declining a bit or growing at a lower rate in 2018 than 2019. So we're favorable to copper going up a couple of $100 a ton, but not the kind of $1,000 boost that we see on the nickel side. And finally, in aluminum, as you mentioned, stocks, whether LME stocks or SHFE stocks in China, are going up. We've seen a high level of inventory, and we think that will be adequate to satisfy demand growth.
All right, Ed, we'll let you go at that. Really appreciate you coming by and taking your time out and giving us your opinion on all of those commodities and currencies as well. So that's the view coming in from Citi. Consolidation in case of crude oil prices, buying for precious metals and industrial metals, and their favorite picks, of course, are nickel and zinc going forward. On that note, we'll slip into a very short break. When we return, we'll discuss what the government must focus on that upcoming agri-expert meeting called by the PM himself. We will be joined by Ravindra Agarwal of Kisan Craft. Stay tuned.